One of the biggest mistakes investors can make is confusing a good economy with a good market. They're related, but they're not exactly the same thing. Markets don't just react to what's happening today, they're going to react to whether reality turns out better or worse than expectations. That's why this earnings season will be so important. Analysts are currently expecting S&P 500 earnings to grow by more than 20% for the second straight quarter. Even more interesting, companies have issued more positive earnings guidance than negative, something we don't typically see. Now, at the same time, the economic backdrop continues to normalize. Oil prices have come down, wage growth remains moderate, and longer-term inflation expectations are still well anchored. That gives the Fed room to stay patient while the economy continues to grow. We're also seeing market leadership run. Instead of relying on just a handful of tech stocks, sectors like financials and healthcare quietly started to participate as well. That's generally a healthier sign for markets over the long run. Now, none of this means we'll avoid volatility. We almost certainly won't. But successful investing isn't about waiting for perfect headlines. It's about recognizing when reality turns out just a little better than what's already been priced in. That's why we continue to stay disciplined, focus on the long term, and look beyond the daily noise. Thanks for tuning in. We'll see you next week with more insights.